Good morning, everybody. Today is February 21st, 2024. Happy NVIDIA Day. NVIDIA earnings are this afternoon. The market is sitting there waiting with bated breath because the whole freaking thing stands on this one company. Well, what's the worst that could happen? Don't answer that. I'm sure everything is going to go just fine. I'm sure they're going to report a just magnificent monster blowout and everybody's going to be gushing and me, Kevin's going to be giggling and up everything goes onward and upward to new highs. Or it won't. One or the other. Maybe Jack's Twitter DMs are going to be hilarious this afternoon, as all the NVIDIA bros love to just chime in when NVIDIA has good days. They're hilarious, by the way. You guys are adorable, and thank you for the engagement. Or my Twitter DMs are going to be crickets this afternoon, as all of these keyboard warriors suddenly don't have much to say. We'll see. Time will tell. But that's not even the biggest story right now. It'll be the biggest story this afternoon. The biggest story right now is what the heck just happened at HSBC. That bank has posted a $3 billion impairment charge, not a credit loss. This is an impairment charge on their stake in China's Bank of Communications. HSBC has a large stake in this bank. They took it out, I believe it was in 2004. They bought a stake in this bank. It had gone up by billions of dollars over the years. Well, HSBC took a hard look at the Bank of Communications and their financials and said, guys, we better start writing down the value of this bank because I don't know if you've noticed things in China kind of do right now. And so they're taking a $3 billion impairment charge on that stake in that Chinese bank as the collapse of Chinese real estate bubble continues. And, you know, I've long suspected, if you go all the way back to my discussions on Evergrande, like when was that? Like late 2021, I think is when I first started talking about Evergrande. I had theorized that it would hit European banks first and that HSBC had more exposure or would be one of the ones with the most exposure just because HSBC has done so much business in Hong Kong. I just figured they would be the first. Well, it looks like that contagion from China's banking system from their real estate collapse is finally starting to affect European banks, HSBC taking that big hit. They also took a $2 billion hit, I think it was, on the sale of their French retail banking business. So those two things combined, those two big impairment charges, have resulted in an 80% decline in HSBC's earnings for this quarter. And of course, HSBC stock is getting clobbered this morning as a result of that. Another big story that's going on is Palo Alto Network, ticker PANW. They posted yesterday. Now, Palo Alto has had a monster run for the last year. They're a cybersecurity company, but they've been one of those companies that just says AI as much as possible. Give me another press release with AI in the title. I don't care what you say. The upstairs bathroom is out of toilet paper, brought to you by artificial intelligence. That's worth another $50 billion in market cap for any company that does something like that. Well, they posted last night, and it was a great quarter that they posted. Earnings beat top and bottom line like everybody else does. And then they got to their guidance. Ooh. And they lowered their guidance. Wait, what? I thought artificial intelligence guidance only ever gets raised. Nope. Palo Alto lowered their guidance, made a cryptic statement about a difficult customer. No detail on who that is or what that might mean. But that lowered guidance, Palo Alto Networks is getting crushed this morning, down more than 20% before the opening bell. Now, Palo Alto, cybersecurity firm, it's not a pure AI play. But a lot of this AI FOMO cash has piled into Palo Alto Networks. I don't know. Take the Palo Alto story. Take what happened to Supermicro on Friday, dropping 20% on options expiration. Dropped another, I believe, 10% yesterday. We had Nvidia and ARM Holdings were both down mid-single-digit percents yesterday. It's starting to feel a little bubble poppy out there. Now, hey, man, NVIDIA reports this afternoon, and there is no way to mathematically model a FOMO mania or a stock market bubble. NVIDIA is running on pure psychology right now. It has nothing to do with fundamentals or valuation or even earnings, just the perception of what future earnings might be. And right now it's priced as if it's more valuable than the freaking sun. And that could continue, or all of these other tremors that we're starting to see with SMCI and with ARM and with now Palo Alto. Could these be indicators? Even a few in the mainstream press now. We've got Jim Chanos, Dan Nathan, that analyst, I forget his name, over at Barclays last week. You have some mainstream voices now starting to question this seemingly impenetrable narrative around Nvidia stock. Well, is it going to be this afternoon, or do we have to wait another 3 months? We'll find out this afternoon when they report after the closing bell. We also got a big jump in U.S. mortgage rates, back above 7%. Mortgage rates had plummeted last fall, particularly in November and December. They had just crashed as U.S. interest rates started to collapse. The 10-year yield was down pretty big. I talked a lot about these subjects of interest rates and money supply in my interview with Joe Brown that I published yesterday. Joe is a really smart guy and a great teacher. Check out that video if you haven't seen it yet. And then this morning, we get data on mortgages. The average mortgage, according to the Mortgage Bankers Association in the United States, is now 7.06%. Back above that all-important 7 handle. That is way up. And right on cue, we got mortgage applications this morning. They are down 10.6% last week, as people don't want to take out mortgages above 7%. Refis also down 11%, because who in their right mind refis into a 7% mortgage? So the housing market is now starting to remember, hey, interest rates are pretty high and they're heading higher. We've got Amazon is replacing Walgreens in the Dow Jones Industrial Average. Walgreens is out. Amazon is in. That change takes effect Monday. That should affect those stocks. I'm not sure what the effect on the overall index is going to be. Keep an eye on that one. South Africa just made an interesting announcement. They are going to be selling off their central bank's currency and gold reserves, or at least a portion of them, tapping into them in order to pay down debt. Now, that is interesting because that does sound like a fiscally responsible thing to do on the surface, and the market is reacting as if this is a fiscally responsible thing to do. The rand is actually increasing in value right now. That's the South African currency. However, as this Bloomberg article we're going to show points to, this is a can of worms, and if you don't back up this action with some of the tougher measures that aren't always so politically palatable, then really all you're doing is shooting yourself in the foot. So we'll keep an eye on that one. But again, guys, the big story, everybody is just waiting on those Nvidia earnings today. Only time will tell what that one is going to do. With that, why don't we shrink my big melon of a head and let's just see what's going on in the markets this morning. Don't forget that like button for the YouTube algorithm. It really helps me out, everybody. And if you're new here, hit that subscribe button and the notification bell right next to it and have your coffee with the melon heads, because we do this every morning. The S&P is currently down 10 points or 0.2% lower. Modest losses for the S&P this morning. I don't think we're going to get any big moves until this afternoon, though. The Dow is down 56 points or 0.15% ahead of the opening bell. And the NASDAQ is down a little bit more, 0.5% lower, down 96 points this morning. We've got we did have a slightly stronger dollar right up until Jack opened his big mouth. Now we're down 2 basis points at 104.06 on the DXY this morning. Pretty much unchanged for the day. Looking over at the bond market, we have got yields are lower on the long end of the curve, slightly higher on the short end. The 30-year Treasury is at 4.441. That's down 1 basis point this morning. The 10-year is down almost 2 basis points, yielding 4.258. The 2-year is down almost 2 basis points, 4.593 on the 2-year. And the 1 month is at 5.396. That's up a fraction of a point. That 1 month has been creeping up ever so slightly these last couple of days, just a fraction of a point every day. We're right back to almost 5.4 there. Keep an eye on that 1 month. That's interesting. On the commodities board, we have got April gold futures at $2,040. That's up about a quarter today, 0.01% higher. March silver futures at $23.08. That's down a nickel or about 0.21%. We have got platinum is down 1% and change. Palladium is down 1%. And West Texas Intermediate crude oil, April futures at $76.72, down about 30 cents this morning. Not much happening in commodities. And Bitcoin watch. Bitcoin has taken a bit of a dive this morning. We are at 51,191. That's according to Coinbase as of 9:11 a.m. Eastern time this morning. And check out this level here, guys. Right above 52,000. What do we got? 1, 2, 3, 4, 5, 6, 7 days in a row. We failed to break above that level. So watch that 52,000 threshold there. It's really acting like resistance. I don't know if we are just sitting here consolidating while we wait to break above that, or is this going to be a rejection and a move lower? Much like so many other things, only time will tell. Bitcoin still has tailwinds from the ETF cash inflows that has been propelling Bitcoin higher. You've also got the tailwind of people front running the halving cycle, which is less than 2 months away now. But at the same time, headwinds include things like fraud, things like Tether. There's obviously no shortage of crooks in the crypto space, and that's always a headwind for Bitcoin. But right now, it looks like it's having trouble breaking through that 52 level. Now, let's look at this one. This is, in my opinion, the biggest story in finance right now, at least until Nvidia earnings come out, because this is a big one. We've been waiting for something like this for years, the collapse of the China housing market and Chinese developers to finally hit Western banks. And it looks like this morning is the first whispers of that. China's economic troubles are hurting global banks. This is in CNN Business, released just this morning. HSBC posted a big drop in quarterly profit on Wednesday after taking a $3 billion hit on its stake in China's Bank of Communications, or BOCOM, and another charge related to exposure to the country's troubled real estate industry. The Asia-focused lender reported an 80% drop in pre-tax profit in the last 3 months of 2023. That's compared to the same period in 2022, it said in a statement. HSBC attributed the decline to a pair of charges that it took. Of the total, $3 billion was related to the Bank of Communications, one of China's biggest banks, while $2 billion was from selling its retail banking business in France. HSBC said the $3 billion impairment was calculated after a December evaluation, which included an estimate of future cash flows at Bank of Communications. Separately, HSBC made $3.4 billion in provisions to cover expected credit losses and other charges related to its exposure to commercial real estate sector in mainland China. So there you have it, guys. The first European bank to post credit losses, to take impairment charges on the fallout of the collapse of the Chinese housing sector, the Chinese real estate market. Backing out a lot of this mess, it looks like performance was a little worse than expected, with higher operating costs more than offsetting slightly better impairments. That's according to Matt Britzman, equity analyst at Hargraves Lansdowne, who wrote that in a research note. And a couple other things I just want to say here. HSBC isn't the only European lender to be affected by China's property woes. In October, rival Standard Chartered reported a $186 million credit impairment charge related to the commercial real estate in China. So finally reaching Chinese shores, HSBC taking a big hit. This is an 80% reduction to their quarterly profits that they just posted, and the stock is acting accordingly right now, down 8.3% ahead of the opening bell. So this is a big bank, guys, $156 billion market cap. They're down 8.3%. We'll see if we hear any more about banks taking hits from Chinese real estate. Now, keep in mind, 2 weeks ago, guys, we had banks on 3 continents report taking hits from U.S. commercial real estate, right? There was New York Community Bank. Obviously, we talked about that one a lot. They're getting clobbered by office and multifamily rent controlled. And then we had Azora, the Japanese bank with a lot of U.S. office exposure. They got clobbered 2 weeks ago. Deutsche Bank posted big losses. Deutsche Pfandbrief Bank, their bonds are trading like Evergrande bonds. Now we've got HSBC reporting damage from Chinese commercial real estate. So East and West are battering the banking sector right now. Keep an eye on this story, guys. And another one coming out of China this morning. Check this one out. China tightens the grip on stocks with a net sale ban at open and close. This is another one of those peculiar regulatory moves in China here. The CSRC, that's like China's SEC. They ban net selling by major firms in the first and last 30 minutes of the day. Kind of obscure regulation here. China has banned major institutional investors from reducing equity holdings at the open and close of each trading day, part of the government's most forceful attempt yet to prop up the nation's $8.6 trillion stock market. The order from China's securities watchdog was recently delivered to major asset managers and the proprietary trading desks of brokerages, according to people familiar with the matter who asked not to be named because nobody names their sources anymore. The China CSRC, led by newly appointed chairman Wu Qing, has also created a task force with the nation's stock exchange to monitor short selling and issue warnings to firms that profit from the wagers, the people said. So more stock price controls coming in China right now. I mean, look, when you ban major firms from any net selling in the first and last 30 minutes, all that means is do your selling on the 31st minute or get your sell orders in more than a half hour before close. It's not like everybody's going to be just holding more stocks now. That's just not how this works. They're just shrinking the trading days for the major trading desks. That's all they're doing. I don't really think this is going to have any effect on the Chinese stock market. Maybe this is just all about showing that they're doing something. I guess that's what it is, but more head-scratching regulations coming from the communist paradise that is the People's Republic of China. Right now, the Chinese stock market, this is the Shanghai Composite Index, or the SSE, had another update yesterday. Let's zoom in a little bit here. That is up 6 days in a row, currently at 2950. But I would add that is one very ugly candle right there, guys. Look at the big wick on top of that candle there. That's not a good indicator. It looks like China's stock market has topped out for the time being. And I just want to draw a little bit of a line here. Let's do a little bit of charting here. Guys, I'm not the best TA guy. There are better technical chartists out there than me. But I did notice this little pattern here. It seems we have rejected this line. We crossed above it, rejected, went above it, rejected, bounced around it right here, stayed above it a little bit here, rejected again, and now here we are over it, and it looks like we're heading back down. So a lot of really ugly squiggles right there, but I think we may have seen a temporary top for Chinese stocks. We'll see if this thing sells off tomorrow. Keep an eye on that one. And let's talk about Palo Alto Networks. This is another one of those AI darling stocks, not a pure AI play because it's a cybersecurity firm, but these guys have really been trying to hitch their cart to that artificial intelligence horse, and they're paying the price for it right now. Palo Alto Networks shares plunge after the company cuts full-year billings and revenue guidance. Palo Alto Networks shares plunged after the company lowered its full year. Shares of cybersecurity company Palo Alto Networks plunged 19% in the extended trading Tuesday after the company reported a beat on the top and bottom lines, but lowered its full-year guidance for revenue and billings. The company's now guiding full-year total billings between 10.1 and 10.2 billion. That's compared to their previous guidance of 10.7 and 10.8. Market ain't going to like that. Palo Alto Networks also expects full-year revenue to range between $7.95 and $8 billion. That's compared to prior guidance of 8.15 and 8.2. There's another guidance lower there. In a conference call with analysts, CEO Nikesh Arora said the lowered guidance was due to a shift in strategy, wanting to accelerate growth, our platform migration and consolidation, buzzword, and activating AI leadership, adding that the company expected a difficult customer as the company shifted stance. And that statement right there is really, I don't know what to make of that. The company expects a difficult customer as the company shifts their stance. Who is this difficult customer? Why are they being difficult? Are they just having a bad day? Are things not okay at home? Or is there a big company out there that's in big trouble and Palo Alto's trying to warn us? That line really jumped out at me. I don't know what it means, but I will be looking for more color on that one in the days ahead. Guidance for the upcoming quarter also fell short of consensus estimates. Analysts surveyed by LSEG expected the company to guide for $2.04 billion, but Palo Alto now expects revenue to range from 1.95 to 1.98. Now, guys, let me just tell you, what Palo Alto just did, this guide lower, even though they posted a big beat, top and bottom line. If Nvidia does this afternoon, hold your breath tomorrow because it is going to be a bloodbath in markets. I'm not saying Nvidia is going to do this. Sooner or later, though, Nvidia will definitely do this. I don't know if it's going to be this quarter, next quarter, the one after that, 3 years from now. But sooner or later, it's going to happen. Their guidance is going to come in light, and the market is going to puke on that news. Palo Alto, look at what this stock is doing this morning, down 25.25% ahead of the opening bell, trading at $273, down $92. Now, guys, look at this one-year chart of Palo Alto stock here, all right? And when did this thing go vertical? It went vertical early 2023, late 2022. This is an AI stock. This is an AI bubble stock. It nearly doubled, or it was up like 60 or 70% last year based on all these buzzword press releases and AI statements. And now it's getting crushed down 25%. Now, that 25%, let's put that in context, guys. It's trading pretty much where it was at the start of the year. All right. So it's not like, yeah, the stock is collapsing. It's down 25%. It's probably going to get halted at some point if this keeps up. It may have been halted already. I don't know. But it's only shed about 1 or 2 months of recent market gains. This thing could go a whole hell of a lot lower. That's the point I want to make. When you're looking at the declines in these stocks, like, oh, it fell 20%. I'm going to buy that dip because stocks never drop more than 20, 30%, right? Look at relative what you're talking about here. Oh, my God, it has collapsed 20% to where it was trading at a week ago. This stock could go back to where it was trading at a year ago, 2 years ago. It's got a lot more room below it if this AI story really ends up being a nothing burger. So keep an eye on that one, guys. Again, another big one, Palo Alto Networks. And check this one out in Bloomberg. Pay attention, you real estate guys and housing bulls. U.S. mortgage rates jump above 7% for the first time since December. That's a big milestone. U.S. mortgage rates jumped above 7% for the first time since early December, dealing a blow to the housing market's nascent recovery. Nascent recovery from what? Well, the housing market never collapsed. What are they recovering from? I found that to be a little odd. The contract rate on a 30-year fixed mortgage increased 19 basis points in a week. That's ended February 16th to 7.06%. According to the Mortgage Bankers Association data released Wednesday, it was the largest weekly increase since October. Big jump in mortgage rates, and you can see it in the applications, guys. This is in trading economics. Mortgage applications in the U.S. plunged by 10.6% in the week ending February 16th, extending the 2.6% decline from the earlier week. And that has marked the sharpest decline in mortgage demand this year, nearly matching the 10-month high decline of 10.7% in the final week of 2023. The result was consistent with a 19 basis point jump in mortgage rates to over 7%, significantly increasing the cost of mortgages for households after data pointing to a strong labor market and stubborn inflation lifted benchmark long-duration treasury yields. And we've also got applications to refinance fell by 11% from the previous week, ended February 16th. So fewer mortgage applications, fewer refis, 7% mortgages, further freezing the housing market. And you can kind of see that in this chart here, guys. This is the 10-year treasury. We looked at that. Here was that monster run that it had last year. Everybody was freaking out. Interest costs on the debt were going crazy. Then Bill Ackman covered his short, and everybody started betting on the Fed pivot. And, oh, my God, we're going to get 7 rate cuts in 2024. We're going right back to Zerpenberg. Interest rates fell pretty much until the beginning of the year. And as my buddy Joe pointed out in that interview yesterday, look what interest rates have done since the start of the year, guys. Pretty much steady up here. Now, is this going to be a continuation of the trend from late last year? Was this just a modest correction and now we resume upward? Or is this just the return to normal phase and these things are going to puke down lower? I don't know, but I can tell you, if we were to get some kind of a collapse in stocks, say Nvidia comes out and reports lousy earnings today. Maybe they do, maybe they don't. But if they do, you are probably going to have a flight to safety tomorrow where people just pile into long duration treasuries, anticipating a recession, anticipating collapses in stock prices. If that were to happen, we are going to see a big red candle down in the 10-year yield tomorrow. Another story going on this morning. I'm not sure how big this one is or not, to be honest with you. Amazon to replace Walgreens in the Dow Jones Industrial Average. Walgreens is out. Amazon is in. This is going to be, the Dow will be a better reflection of the U.S. economy. Walgreens is obviously not the biggest company in the world. It's a pharmacy stock. People spend a lot of money there. But compared to Amazon, I think this is an improvement for the Dow as far as it's being an indicator of the overall economic health of the country. I don't know that this is going to move the needle on the index. The change takes effect at the open on Monday. Walmart will remain part of the Dow, although its upcoming 3-for-1 stock split, effective after the market close on Friday, will reduce the retailer's weight in the index. You've also got this split in Walmart happening. The Dow is weighted based on the share price of its components, not on each company's overall market value. So we'll be keeping an eye on that. Again, I don't know what the actual effect on the Dow is going to be from this change, but Walgreens right now down 3%. because a lot of ETFs are going to be selling Walgreens stock because it's not in the Dow anymore. So those ETFs that trace the Dow, they're going to be dumping Walgreens and they're going to be buying Amazon. So you've got Amazon is actually up 0.8% ahead of the opening bell, trading at 168.50 right now. Last story for the day. I'm sorry, two more for the day. South African rand jumps as the nation taps reserves for debt. Bond yields drop as the government presents their budget plan. Less borrowing seen, providing some short-term market relief. The rand strengthened and local bond yields dropped after South Africa said it will tap its gold and foreign exchange reserves to reduce the scale of its public debt sales. The currency advanced as much as 0.8% to 18.762 per dollar by 2:35 p.m. in Johannesburg after trading flat before the announcement was made. The yield on local bonds due February 2035 dropped 10 basis points from closing levels to 11.57%. While the benchmark stock index was slightly down for the day, bank stocks, however, were rallying with the gauge climbing as much as 1.1%. So South Africa is going to borrow less money. And what they're going to do is they're going to tap into their bank reserves and they're going to sell some of their gold reserves in order to pay down debt. Now, paying down debt sounds like a great idea, but there's an asterisk. If you're going to pay down debt only to go ahead and increase your debt again by spending more money later on, then you haven't really done anything other than sell your reserves, other than lower your gold position. So if there's no fiscal restraint associating with this, then they're just shooting themselves in the foot here. And Bloomberg is getting into this a little bit with this statement here where they say can of worms. The market read this move as a more positive outcome for debt because it appeared that spending was being constrained, said Robert Hoodless, co-head of FX and macro at InTouch Capital. The rand and local bonds understandably rallied on the outcome, which was combined with lower debt to GDP profile. But for the currency to continue appreciating in the long term, the optimism must be followed with fiscal promise delivery. In other words, if they don't cut spending after doing this, then this is just a temporary solution. They're going to make the problem worse, and they're going to come out the other side with the same pile of debt and fewer gold reserves. In other words, they just screw themselves. So many will likely be skeptical that debt can be kept down to a lower path over the next few years, he said. And while the opening of the GFV CRA, I don't know what that is, will admittedly lower to the admittedly lower tune of 150 billion rand is below many forecasts, this can of worms is now open for future raids depending on the political environment. That statement's important there. This can of worms is now open for future raids. So they've finally set the example that, hey, if people are beating you up on your debt and your currency, just sell some of your gold off. Don't change your behavior that caused the problem to begin with, and everything will be just fine. That can of worms is now open. So if South Africa doesn't do anything about their fiscal situation, this will just make things worse. And lastly, guys, just want to mention this. NVIDIA reports earnings today. They're a flashpoint for the market. That is mildly put. The whole freaking house of cards depends on what NVIDIA says this afternoon. NVIDIA reports later today and what's likely to be the most closely watched report in the company's 3-decade history since the last one. With the chipmaker stock up nearly 50% this year, expectations are certainly high. How high are they? That's a good question. Wall Street analysts expect NVIDIA to report January quarterly revenue of $20.4 billion, up nearly 240% year over year, with adjusted earnings per share of 4.59%. NVIDIA's outlook for the current quarter will be just as closely watched as a proxy for artificial intelligence demand. Any large moves in shares of NVIDIA can affect the tech sector and have the potential to impact the broader market too. Mildly put statement right there. Now, guys, here's the thing. Wall Street expects blah, 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 up 240% year over year. That's the problem. This company could report growth of 150% year over year, and that would be disappointing. That the stock would crash on that news because the market expects 240% growth. It's not about earnings. It's not about demand for chips. It's not about how cool the chips are. It's not about how much you know about the technology. And, oh, you talk to a guy who solders circuit boards or something, and he says they're really good, and therefore all this talk about channel stuffing and round tripping is irrelevant. No, it's about revenue growth, top-line revenue growth. If that revenue growth disappoints, this stock is toast. Even if the revenue is still growing, it can still be growing and the stock can still crash because they expect it to grow 240%. Nobody can maintain that growth rate forever. Nobody, even liars and crooks. Eventually, the numbers get too big. You can't do it forever. Is today the day? I don't know. Maybe it is, maybe it isn't. But one way or another, it's going to be an interesting afternoon. And my Twitter DMs are either going to be hilarious or it's going to be crickets. Because all you guys who just love to message me every time NVIDIA stock has a green day, I think you guys will be quiet. You won't be saying very much if NVIDIA stock is down tomorrow. But we'll see. I want to say thank you very much to M&J, who gifted 10 channel memberships. Well, thank you, M&J. I appreciate that very much. And guys, if you were gifted a channel membership by M&J, by all means, send a thank you. And don't forget this guy who loves to make me put his name up on the screen, Mr. BTB. 3 times now. 3 times you got me with that. He gifted 5 memberships. So thank you for probably getting me flagged by the censors and, you know, the screenshot joke on Twitter. I'm sure that's going to go over well. Don't forget to thank Mr. Bagger if you got a channel membership from him. And thank you from No One to No One for the super chat. He says, Jack, is HSBC the same bank that laundered money for the cartels for quite some time until the U.S. got involved? As a matter of fact, it is. Yes. It's funny you should mention that. Look, all the banks have done it. Credit Suisse did the same thing. They all get caught doing business. They maintain their little bit of deniability. Oh, we had no idea this guy was an international drug lord when he showed up with suitcases full of cash on a daily basis to deposit it at our bank. HSBC, I've kind of suspected them for a long time just because they were so heavily involved in Hong Kong. And anything that happens in the Chinese housing market is going to affect things in Hong Kong. Those markets are hopelessly intertwined. I didn't have any actual data or numbers to support that. That was always just a hunch. I don't think HSBC will be the last bank to report problems from China. I think the fallout from the Evergrande collapse and the eventual Country Garden collapse, I think it hits Europe before it hits the States, just because it always seems like European banks are more exposed there. Now that's direct bank exposure. You've also got, Apple makes their phones there. Nike makes their clothes there. All the American companies try to sell their products into that markets. American movie studios are absolute whores for Chinese government censors. So everybody bends over backward to get their product into that market. So the collapse of the Chinese consumer due to the wealth effect will also spread to the States and will affect U.S. companies. But as far as financial contagion goes, I think the European banks are more exposed. And that's always just been more of a gut thing than anything else. But thank you, No One to No One. I appreciate the super chat and the support of the channel. And thank you, Joey Sox, who says, "Yous guys are great for Jack's Coffee Fund." Well, thank you very much, Joey Sox. I appreciate that. I also see Paulie Walnuts there in the channel icon. I appreciate that very much, sir. Thank you for the coffee. I shall enjoy the wake-up juice. And welcome new member Mark Sage. Thank you for becoming a Melonhead, sir. I appreciate that very much. And thank you, everybody, for having your coffee with the Melonheads this morning. NVIDIA report this afternoon. It's going to be big one way or another. Which way does it go? Let me know down in the comments. Thank you, everybody, for all of the super chats and for having your coffee with the Melonheads. Thank you to my magnanimous Melonheads on Patreon and YouTube for supporting the channel. Looking forward to talking to you guys this afternoon at 4 p.m. Eastern Time for our weekly Zoom call. I got links down below to all that good stuff. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.